All right, that's about Engineers India. With that, we'll step into a short break. On the other side, we get chatting with the management of Shriram Properties. They will detail their outlook post their fourth quarter earnings.
Hi, welcome back. You're still tuned into Chartbusters on CNBC TV18. Well, some more selling is what we are seeing on the Nifty. It is at that 16,412 mark at the day's low, sitting with cuts of around 156 points. And we'll have to see whether it breaks those levels further or not. But for now, we are seeing some selling from the top as well. But the stock that we are focusing on is Shriram Properties. That is what we are tracking today. Company reported a 14% sequential uptick in sales volumes in Q4. Overall volumes were up 25% on a YY basis. The stock, however, is lower. It has been flattish so far this week and is down 37% from its 52-week high. What's the outlook on launches and demand? We have with us the Chairman and Managing Director of the company, Mr. Murali M. Mr. Murali, good morning. Thanks a lot for joining us. Well, Q4 has been good for you. You have ended FY22 on a decent note. However, you did mention post Q4 that a 40 basis points rate hike is something that will not impact demand in the longer term as well. But now we are in that scenario where more rate hikes are in the offing. In that case, what do you expect? Will there be an impact on demand?
No, there will not be any impact on the demand. I expect the demand to continue further and further and further. People have just started coming back to the offices now. Work from home is slowly coming to an end. It will take a little longer time, but it's coming to an end. So we see already rentals have started going up. And practically in cities where we operate today, on suburbs or on outskirts, there are no homes available for rental today. And the demand is going further and further. It's just the consolidation, limited supply, and the growing demand, particularly on the mid-market and affordable housing segment. I don't expect the demand to come down for the next 2 to 3 years' time.
Take that point, Mr. Murali, and we also hope that what you're saying, people coming back to offices and coming back out of their houses sustains, given the rise in COVID cases that we've seen over the last couple of days at least. But you know, the reason why rates are being hiked is because there is a fair amount of inflation. Back in the day, you had said that you'd taken about a 7% price hike in the second half of the last fiscal, and this fiscal you're looking at about a 10% price hike. Will that be enough to cover, the inflation that we're seeing, or will you have to increase your rates further than the 10% that you're talking about?
Currently, we hope to have the price increase of at least about 10% for the year now. But inflation, Government of India has done a fantastic job in keeping inflation control, including steel price. I talked about it in your channel a few months ago when the steel price was going up. I said this has been the trend, but it will come down. In fact, we all estimated it will come down a little later, but it has already started coming down in a big way. So this is the initiative from the government for ensuring that inflation is in control. I hope inflation will be in good control. It will not be a major concern for India. Yes, some of the Western countries are going through serious inflation issues, but Government of India is doing a fantastic job in making sure that inflation is kept in good control. Currently, I think it is good enough. If inflation is not in control, then we will take a relook at whether we need to increase the prices. But currently, I think inflation will be in good control within this broader framework, and the current sale price increase what we are looking at, I think should be good enough to manage that.
So 10% is good enough. Is there a chance that if things continue to be on the downward side, you may not even have to raise it 10%?
No, we will increase 10%. See, okay. That is happening not because of inflation alone. It is because of the consolidation which is happening. Okay. The supply-demand gap, particularly on mid-market and affordable housing segment, there is a huge supply-demand gap. The demand is here, supply is here. So that is the big opportunity for large branded players like us to take advantage. And also the market, it's not that we are taking opportunity. See, we all suffered, all the developers have suffered in the long period of time. So this is time for us to look at making some money, some extra income to make out of the prevailing situation now.
Your shareholders will definitely like that, maybe not the buyers. But Mr. Murali, let me talk about your debt now at around 480 crore rupees at the end of FY22. You did say that you plan to become net debt free by FY24. In FY23 itself, how much debt will you be able to reduce? And I was also looking at your PNL. FY22 interest cost is 120 crore rupees, which is on a debt of 500 crores. Can you explain that to us?
So we are one of the lowest debt equity company in real estate. Its net debt is about 0.3 at this point of time. we expect this to come down by FY24 to zero practically from the current existing projects. FY23, we expect good, cash flows are likely to come in from the project itself. A lot of projects are getting into completion, so that alone will, retire the current debt. And also there are a couple of assets, we are liquidating now that will throw some more cash flows. So FY23 will be a good cash flow year for us, and debt will come down significantly. And we expect by FY24 from the current projects will become debt free. And also next 2 to 3 years time, we expect to generate free cash flows at least about 450 crores.
What explains this interest expense or finance cost of 120 crores then? Is that an element of rent or lease payments that you've made?
No, it's just the interest. See, gross debt is what we need to look at. Net debt is about 300. Gross debt is about close to about 500. That also we are looking at.
But even on 500 as a gross debt, 120 crore interest expense is a lot. That's roughly, 20% sort of interest expense.
No, our interest today is about 12 to 13% is our interest today. We are looking at this year bringing down the interest rate by at least about 150 basis points. We are looking towards that.
And you will be debt free by FY24?
Yeah.
Okay.
From the current projects. For all the current projects, we'll become debt free by FY24.
Okay. Mr. Murali, I was going through a presentation where you said that you are making a cautious entry into a new market, that is Hyderabad. Can you explain this term cautious, and what kind of investments or launch pipeline do you have in Hyderabad? Because that is coming up as the next big market for residential as well as commercial properties. Why this cautious approach then?
Any new markets, today we need to look at, for example, we are present in Bengaluru, Chennai, Hyderabad, Vizag, Kolkata and Coimbatore. This current set of market, what we are present today, gives a tremendous opportunity for the next 3 years growth. The project pipeline is so strong for us, so we are, having a good pipeline for next 3 years growth. There is no necessity for developer to go very aggressive on new markets. Each market has got its own, challenges and opportunities. So every market has got an opportunity, also a challenge, and every market behaves in a very different way. So that's why I said any market, any developer, when they take a new move, they need to be very, very cautious and go very conservative. So Hyderabad is the launch we are making in now this year, and we have signed up one project which is about 810,000 square feet. So that's a project we'll be launching. Based on how the response is, and we'll make a slower expansion. We'll not expand aggressively in the first year itself.
Right. What's your long-term target for collections? Because last year you did about 1,200 crores net collection. This year would be close to around 1,600 odd crores. In the long term, what's your guidance for the same? Yeah,
this year FY23 we are looking at about 1,600. 24 it could be close to 2,000 plus. So that's where we are looking at FY24. So we are looking at growth 25% CAGR for the next 3 years at least. So from 3.76 million square foot, we'll go to 4.5 million square feet is the estimate for FY23. From 4.5 to we aim to go closer to 5.5 million square feet by FY24. We'll make 25% CAGR is the target what we're having for the next 3 years time. While on the pre-sales, on the balance sheet side, last 3 years, whatever the sales which has been done, over 10 million square feet has been done, 70% of that, whatever has been sold, coming for recognition for FY23 and 24. 60% of the project has been sold until last year on DM, coming for revenue recognition. So we are likely to have a very healthy balance sheet. We are likely to have a healthy cash flows for the next 3 years time from the projects which are already been sold until last year, and also the projects are being launched this year.
Okay, all right, Mr. Murali, it was a pleasure speaking with you. Thank you so much for joining us and giving us all those details. That's the word coming in from Shriram Properties, a strong pipeline and guidance going forward. With that, we'll slip into a short break. We'll get you more on stock-specific action on the other side. Stay tuned.